Let's ask our headliner today, Tom Lee. He's FundStrat's head of research, chief investment officer, also a Cnbc contributor, and it's good to have you back. Welcome.
Great to see you, Scott.
Told us that you thought the bottom was in and that new highs were in reach. Here we are. Now what?
I know this is going to sound counter to what the viewers might think, but I think the stock market is in a better position today than earlier this year when it made its all-time high. Because one, we're now seeing that the U.S. stock market can handle a surge in oil while it hurts other countries. We've seen earnings go up, so we now feel comfortable that the war is actually stimulating the economy. And the third is, I know I've talked before about inflation shocks, but we've been looking back at the history of oil spikes, and the impact on core is less than we thought. So I think there may be less of an inflation shock coming. So I think stocks can go back to that 7,300, which is our base case for this year in our three-phase market, before we might see a larger drawdown.
Well, I hear you essentially saying that the U.S., in some respects, as a result of this war, is the best house in a now more uncertain neighborhood.
That's right. This is a seventh black swan now thrown on investors since 2020. And now we've seen that the U.S. can handle a Middle East catastrophe, one where the strait is closed and oil's not available. The U.S. economy is still operating while other countries are talking about shutdowns and factories closing.
You don't feel in any way, or you're not concerned that you may be complacent to the risks that are still out there because of the war?
There are tail risks. I think that the size of the tail has shrunk, tail meaning a downside risk. And I do think that there's a lot of folks who are credibly pointing out that the shock could still hit the shore in the U.S. because of things like helium and other commodities. So we are watching that, Scott. But I'd also say that we could have a positive tail risk, which is if we can find a lasting ceasefire, then whatever shock hits the shores is so short in effect that it won't hurt our base case.
The NASDAQ is trying for its 11th straight positive day. It'd be the longest streak since November of 2021. There are those who believe, like J.P. Morgan does, that if the next leg of the rally is going to be strong, tech is going to have to lead. Do you agree with that call?
Yeah, we do. I think that it's still useful for people to look at what has outperformed since the war started. And, number one has been Ethereum and Bitcoin, which are crypto, but they're highly correlated to tech. Of course, there's energy stocks, but then it's led by tech, and the Mag 7, and even the software. So I think that J.P. Morgan's correct. I think tech is growth when people are worried about growth. And of course, it's also been the most under-owned group because that's the group people were selling.
Well, part of the call is that you're going to get the best earnings growth from tech. There are more notes about that today, while at the same time, valuations have fallen. So these stocks in some people's eyes aren't as pricey as they used to be and look even more attractive because earnings growth estimates are solid, if not increasing.
That sounds right, Scott. These companies have true moats. They've grown earnings consistently faster than the S&P. I think they're going to be one of the winners around AI. And you're right. To buy them at a market multiple means that 5 years from now, I think people are going to be surprised that they could buy them so cheaply.